Talk global markets right now. Joining us in her first Squawk Box appearance is Robyn Grew. She is the CEO of Group. That's a global alternative investment management firm with more than $193 billion in assets under management. Robyn, first of all, welcome. It's good to have you on the show.
Thank you very much for having me.
Let's talk a little bit about what's happening with global markets right now. What are your views on this?
I think it's a time where you're seeing volatility, you're seeing dispersion, you're seeing opportunity. And that's something that is great for firms like mine, who are looking to provide lots of solutions and uncorrelated returns in the way that we can help clients navigate this. It's a time for diversification of portfolios, and whether you're running $1 trillion as an allocator or you're running your own IRA, diversification is going to help you out.
Why do you say volatility? Because it seems like the markets, at least in the United States, have basically just moved one way, and that's up.
Well, the equity market is remarkably resilient here. I think we've been talking for the longest time about aren't equities priced to perfection is the word that we've all been using, and since that time it continues to go up. So you're right, in the equity space in the US it continues to be incredibly strong, but within that there's dispersion. And within that, you can see the value of active investment across the equity portfolio. But I'm talking about beyond that, in credit markets, in other asset classes. And by the way, across the world, now is a time where you're starting to see, January of this year, Europe was in the doldrums with fiscal intervention, with the ability to see opportunity in other sectors. You can take full advantage of that. So I think you are going to see some volatility, and certainly as we head towards the last quarter of the year, it's going to be interesting to see how equity markets fare.
Can you give me something that's 100% uncorrelated? I'm trying to think of what's uncorrelated. It's hard, isn't it?
It for sure is, but if you take things like credit markets as against equity markets, yep, you are seeing a difference in the way that they perform.
But they've been moving sort of in tandem.
Parts of it have, but parts of it haven't. Okay. And that's the dispersion piece, which I think is most interesting. So active investment, as opposed to just the passive index piece, I think is where there's real opportunity and real excitement.
So as stocks are going up, which parts of the credit market are going down?
We're seeing tremendous opportunities. Let me do it a different way. In high yield, the investment grade, in the lending space, you're seeing great opportunities in private credit. A few years ago, credit was nowhere. But when you start to have interest rates and you start to have inflationary pressures and you start to have lending opportunities again, great opportunities which are uncorrelated to the equity markets.
Both going up, but not necessarily correlated.
Correct.
Okay.
The volatility, though, has not been good to Man Group shares. Your shares are down 22% over the last year.
Volatility, well, in part...
Volatility is supposed to be your friend.
It is supposed to be my friend, but it doesn't necessarily relate to necessarily Man Group share price. That's a response to some of the other pieces of the puzzle that make up our business operation. But the reality is, volatility is a great place for active management, where you can take advantage of the outperformance, the signals and the data you get across both, as you know, in our business, systematic capabilities, so quant investing, as well as the discretionary, fundamental, bottom-up review.
Your assets under management have grown, though, but you did see a 40% drop in the first half core profit. Why was that? It's
the mix of the assets that we have. So when you're having both, we are both an alternative manager, we have long short, and we have long only. And when some of our hedge fund performance, for example, in trend following, starts to struggle because trends aren't as available and identifiable as they were before, that business and those strategies don't work. And that's what got picked up.
So you're talking about the volatility of U.S. policies in particular that have made it hard to figure things out?
Volatility of U.S. policies certainly whipsawed the markets backwards and forwards as people got used to and tried to understand what was the impact of things like April 2nd and the tariffs.
Where do you see policy headed at this point? Because we were just having this conversation about how U.S. businesses might have figured out how to handle some of the volatile policies a little better and kind of are more prepared for it. And U.S. equities markets certainly are a reflection of that.
And you're starting to see, therefore, the trends coming back into markets. That's exactly right. So things seem to be normalizing. Now, listen, I'm coming to you today in a space where we have the first government shutdown in some time. So, I'm super aware of that. But markets, even in shutdowns, have actually fared reasonably well over time. But we are facing a time where we're going to see that policy and the markets can absorb and understand policy changes more readily. I think, quite frankly, that we've gotten used to the pace, but also the resilience has been astonishing. So the number of things that you would have thought would have impacted, increased the risk, have just been shrugged off by the markets. So let's see what happens.
You expect that to continue, that the markets shrug off any concerns that they have about whether it's geopolitics, whether it's policy changes, and instead focus on some of the tailwinds that are maybe coming their way with lighter regulatory touch, some of the other issues that might be helping?
I think it's a really difficult question to answer accurately. I think you would have thought, take me back a few years, because I'm old, take you back a few years and you find yourself in a place where you say, hang on a second, we've got some interesting data. Goldman Sachs piece that just came out recently about asking US insurers what were they concerned about. 52% of them said, well, we're a bit concerned about inflation still. And then asked about, well, what were they thinking about the last sort of end of year? 48% of them said, listen, I am a little bit worried about recession and slowdown in markets. You look at credit spreads in the US, they're not indicative of a recession at all. So the data points are interesting in that they're not seemingly having the market impact that you would ordinarily, or you might ordinarily expect to see. Doesn't mean it won't, doesn't mean that things can't change, doesn't mean that the Fed couldn't become hawkish, doesn't mean that the 10-year yields could be high and that pushes some pressure down on equities, doesn't mean that, let's be clear, AI has this significant impact, or indeed people start to question whether the return on investment in AI is going to materially advance some of those companies who are using it in their future earnings. So there's lots of things that could change, but so far the resilience, particularly in the US, is enviable. How about that?